Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Chris Panayiotou, certified financial planning professional, the Cap and Capitalize. And on today's episode, I'm going to teach you what you can learn from millionaires. But as always, before we get into this episode, the free advice for the week, and it's short and sweet. When in doubt, think deeper. That's it. And I'm going to let you marinate on that free advice as I take you into the new piece of research that I discovered late last year in late 2025 regarding millionaires. And regardless of your net worth, you are going to want to listen into what came of my findings because it will be immensely valuable. Hence why I'm doing the show in the first place. So according to the 2025 Planning in Progress study by Northwestern Mutual, only 36% of Americans with $1 million or more in investable assets considered themselves wealthy. So about a third, which is interesting. The other 66%, or the majority of millionaires, don't consider themselves wealthy. Now, what's even more fascinating is nearly half of these millionaires said they need to improve their financial planning. Interesting. 53% of research participants said they expect to leave an inheritance or charitable gift as part of their estate plan. And among that group, just 12% identified leaving something behind for the next generation as their most important financial goal. And there's a lot of stats I'm going to be layering in here. Okay, so just buckle up. 8 in 10 American millionaires reported that their net worth was self-made, while just 12% inherited their wealth and 5% came into it through a windfall event such as winning the lottery. Now, I'm going to keep going through the survey. According to the survey, although most of the 23.8 million millionaires in the United States do not see themselves as wealthy, they are much more likely to report higher levels of financial discipline, confidence, and clarity than the average American. And that makes sense to me just because if most of them are self-made, which I could go on a rant on what self-made actually means, but if the majority of them are first generation or self-made, they've put prudent processes in place to get to that point. And because of that discipline, that's going to lead to more confidence and clarity into understanding their financial circumstance. 74% of American millionaires in the survey reported that they work with a financial advisor or a financial planner. And that is compared with 34% of the general population. And they also trust advisors or planners far more than any other source of financial advice. 9 in 10 millionaires said they have received financial advice, while 3/4 of Americans in general have done so. Now, millionaires who have an advisor, again, or a planner, reported feeling more secure than their wealthy counterparts who do not work with one and do it on their own. They also expect to retire 2 years earlier than those who do not partner with an advisor, again, or planner. Millionaires with advisors or planners are also more likely to feel strong about their relationships, careers, health, and finances as opposed to those that just do it themselves. Now, although $1 million is a considerable amount of money, I'm not going to discredit that at all. Money alone does not create confidence. Financial advice and financial plans do. And millionaires have 3 top questions about retirement planning. And this is what the survey found. Number 1, is it possible I can outlive my savings? That's a big one. You don't want to outlive your money. 2, how will taxes affect my retirement? And I've talked about that a ton on this show. The best investment return you can guarantee other than investing in yourself is not an investment. It's the taxes you avoid. And then three, how can I plan for potential long-term needs? And that could be just longevity in general, long-term care, things of that nature. Now, for their part, the general public posed these as the most pressing questions as opposed to the millionaires. So for the general public, the first, how much money will I need to retire comfortably? Number 2, will Social Security be there when I qualify for it? And 3, what if inflation rises when I'm retired? So with all of this information, what can we take away from it? What can you take away from it? I'll tell you right after the break. Don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. Now that we've gone through all of this data through that Northwestern Mutual study that I mentioned, here's some practical, high-impact steps that you can take from learning from millionaires. So the first one, pressure test your financial plan and do not assume that your plan is quote-unquote good enough. So what I would do is request a full plan review or, do one on your own if you do things yourself. And what does that encompass? That stress tests market downturns, longevity, so living to age 95 or 100, higher than expected inflation, and unexpected health or long-term care costs. Now, why would you do this? Nearly half of millionaires feel their plan needs improvement. Interesting. Often because it hasn't been tested against real world risks. And if half of millionaires feel that their plans need improvement, what do you think the majority of people feel? Probably that 10 times. Second thing, clarify what wealthy actually means to you. So what I would do is I would write down the income you want in retirement after tax. That's very key. The lifestyle you want to sustain, which kind of correlates with income, but it can be qualitative as much as quantitative. And then the last thing, what financial security means emotionally to you. That could be freedom, safety, legacy, flexibility, combination of them. Now, why would you do this? Many millionaires don't feel wealthy because they lack a clear definition of success. And ambiguity is going to fuel anxiety. The third thing that I would do, get specific about retirement income, not just net worth. And I see this all the time. People will come to me. It's probably one of the most common questions I get from new clients coming in the door. They go, I've thought about getting to a net worth of whatever it is, okay? 500,000, $1 million, 2 million, whatever. And once I get to that net worth, then I'm going to be good in retirement. It's not really the right way to go about retirement planning. In fact, it's completely incorrect. So what I would do is convert your assets into clear retirement income plans. And what does that mean? That can mean a couple things. That could mean guaranteed income as opposed to market-based income or alternative income. That could be having withdrawal rates by different account types. That could be mitigating sequence of return risk, which is basically the ability to protect yourself from a severe market downturn. And I talk about that in my first book, Capitalize Your Finances, extensively. Now, why would we do this? Why would we get specific about retirement income, not just net worth? I've kind of already said it, but I'm going to have to say it again. A high net worth does not automatically translate into confidence about sustainable income. And going further on that, a high net worth does not automatically translate into an actual income stream in retirement, because if a lot of your net worth is illiquid, you're going to have to figure out how to liquidate that. And you're also going to have to manage how to liquidate it in a tax efficient manner. So the fourth thing that I would do, review tax strategy as an ongoing process, not just a one-time set it and forget it. And how would I go about that? I would review a number of things. I would review Roth conversion opportunities, if it makes sense, tax efficient withdrawal sequencing, capital gains and charitable strategies, exposure to future tax increases. And why would we do this? Taxes are one of the top concerns for wealthy investors and clients and people in general. And not only is it one of the top concerns, it's actually one of the most controllable risks with proactive planning. I can give you a very surface level example. So right now, this is being recorded in 2026. Let's say that people come into my office and they have $500,000 in IRA money and they have $500,000 in taxable money, just to keep it really, really simple. And let's say that they're both 65 and they have not turned on Social Security and they need to live off of $5,000 a month. Okay. I'm ripping this off the top of my dome here. So in 2026, when you include the standard deduction as well as the bonus deductions being 65 under the big, beautiful bill, your standard deduction is like 47 grand a year. So your first $47,000 coming from your individual retirement account would actually be tax-free because it's a one-to-one. It's a one-to-one deduction. Well, then anything above that, what you could do is structure your non-taxable money, because capital gains as if you're married filing jointly, the first $98,000 is tax-free. So you could structure it where the first 47 grand, using round numbers, comes from your IRA. And then the remainder that you need, because again, if you need 60 grand a year, 60 grand minus 47 is $13,000. That $13,000 comes from your taxable account. Well, I just made you pay 0% in tax for the first 5 years in retirement until you eventually turn on Social Security. And then at that point, your Social Security has compounded at 5.5% between 65 and 67. Between 67 and 70, it's grown at 8% guaranteed, not including the cost of living adjustments. And so then at that point, you could take your IRA distributions, turn them off. And then what you could do is start to convert those in a really, really low tax bracket, maybe 0%, but probably 10 to 12%. So then by the time you get to the point where your RMDs turn on when you're 73, you could either take those and give those to charity in a form of a qualified charitable distribution, which is a tax-free distribution from your required minimum distributions. Or you could take those RMDs and instead of giving to charity, you could convert at your Roth IRA. You could convert into a Roth IRA at that point, and your tax bracket is super low, which then also further compounds your tax benefit because your net worth grows. And then by the time your heirs inherit that money, instead of IRA money where it is going to be taxable at ordinary income rates, with the taxable money, you get a step up in basis, which is completely tax-free, and your Roth money is completely tax-free. So that's a tidbit of stuff that you could think about. I went on a little tangent, but you're welcome. Now, The fifth thing that I want to go over, closing the gaps in estate and legacy planning. So what would you do about this? Because that can sound really vague. I want you to confirm that you have, and in no particular order, updated wills and trusts, beneficiary designations aligned with intent, and a clear inheritance and charitable plan, even if it is modest. Now, why would you do this? Why are we trying to close the gaps in estate and legacy planning? And why would we learn this from millionaires? Well, here's something kind of crazy. Only half of the millionaires in the United States expect to leave an inheritance, often because planning hasn't caught up with asset growth, which is a huge misnomer because you're a millionaire. I mean, congratulations, your asset growth has caught up. And it may not have caught up to what you think is appropriate to talk to an estate planning attorney, but it doesn't matter. You need to get out ahead of that. And really, it goes for any of you out there. It doesn't matter if you're a millionaire or not. If you have assets of any sort, or if you don't have assets, but you will have assets because you're actively thinking about it, hence why you're probably listening to this show in the first place. You want to get this in place because by the time your assets do start to accumulate, and if something ever did happen, fortunately, your heirs are good, or your charities are good, or whatever your money is going to, they're good. Number 6, evaluate your advisor relationship honestly. So what I would do, I would ask yourself, do I understand my plan? Am I proactive on my plan, or am I reactive on my plan? Or if you work with someone, is your financial planner, because you all know how I feel about advisor, for those of you that have listened to episodes in the past, is my planner proactive, or is he or she reactive? And then another thing I would ask is my planner coordinating taxes, coordinating estate planning, and investments, not just managing a portfolio here and there. And if needed, seek a second opinion or planning first, planning first advisor, someone that is proactive. And unfortunately, most advisors are not in our industry. So the pickings are slim there. Now, why would you do this? Most millionaires have advisors, yet many still feel uneasy. And the advice quality and the scope of the advice, it does matter. So a lot of you millionaires out there that are listening into this episode, just because you have a planner does not mean that they are proactive. In fact, most of them are reactive and they tell you a bunch of jargon, and you would actually be stunned to realize that your plan, it's pretty cookie cutter. Like most planners in our industry stick to 1, 2, maybe 3 portfolios, and they mask that with a bunch of tools, technology, investment jargon, industry jargon, economic updates quarterly. All it is masking the fact that you're in 1 or 3 different portfolios that all the other clients are in. And frankly, that makes their practice more valuable. So when they go to turn around and sell it, they're going to get a higher multiple. I'm not going to name names, but I'm actually reading a book right now. He's a prominent planner in our industry, and he actually coaches advisors and planners on how to grow their practice and scale. And there's some really good stuff in this book. There's a chapter in his book where he says specifically, I have 1 portfolio for all of my clients. And he even goes further to say, I know there's probably better things out there. I don't care. Yeah, you heard that right. Rewind it if you need to hear it again. It's awful. So what I'm saying is get the quality in the scope of actual planning. Number 7, a tip for you, what you can learn. Plan explicitly for healthcare and long-term care costs, or just care in general. And what I would do is I would model out long-term care scenarios, self-funding versus long-term care insurance versus maybe a hybrid approach. There's a number of insurance policies out there where you could, it's not like the olden days where you would have to buy a long-term care policy, but if you didn't use it, you lose it. There are those out there, but you could buy a hybrid policy where it's long-term care as well as life insurance. The long-term care side of it might not be as valuable because there's a hybrid aspect of it, but it can be a cool little Swiss Army knife, because let's say you're using long-term care and you pass away prematurely. Well, then your heirs or your estate, it's not getting nothing. It's getting something. It may not be a lot, but it's better than nothing. And then I'd also model out the impact on your spouse and your heirs or your charities. And why would we do this? Healthcare uncertainty, it is a major driver of financial anxiety, even amongst the wealthy. And so by getting ahead of that, you're completely eliminating that angst. And if you're doing this yourself, great, good on you. And there's a number of tools that you can do and there's a number of tools that you can use in terms of forecasting. You can use our net worth tool on capitalizepodcast.com. We're coming out with a cash flow app where you can model out your cash flow and how that's going to look down the road. So if you're doing it on your own, great. And even if you work with a planner, go on Capitalize Podcast, give it a look. It's very, very affordable. Very, very affordable. And you'll see that when you go on the website. Now, the eighth tip and the eighth thing that you can learn from Millionaires: reduce complexity wherever possible. And how I would do that is really simple. I would simplify the number of accounts you have, the overlapping investments that you have, the unnecessary strategies that add stress without adding value. That's a huge one. And why would we do this? Complexity often masquerades as sophistication. It's sophistication, but clarity builds confidence. And it's interesting. I mean, one of the things that I can think of is this concept of diversification. I'm not saying diversification is not important. I'm not saying that. I think it is completely overblown. I think it's misunderstood. And I think diversification, traditional diversification, is for those that don't know what they're doing. And also, we have a client that is actually coming on board right now, and they're at one of the big firms, and 1 month statement was 390 pages long. And one account had 600 different holdings. I'm like, what in the world are you doing? I mean, I know what the group's doing because the group is buying and selling assets on a monthly basis regularly, which I could go into a whole tangent of why the SEC is very, very, very pro these uber diversified portfolios. That may be for another time. But it's one of those things where all it's doing, it's confusing the snot out of the client. I mean, that's why they're coming to me in the first place. It's adding a boatload to the tax side of things, and they don't know where their money is. And frankly, their advisor has no idea where their money is. I don't care who you are. If you have 600 investments in your accounts, there is no way in God's green earth you are going to know what every company or real estate investment or credit investment is doing. There's no way. 0% chance. So that does it for today's episode on what you can learn from Millionaires. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments investments involve risk, including potential loss of principal. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution (RMD) in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. The information provided is based on current laws, which are subject to change at any time. Capitalize Your Finances is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Long-term care coverage policies and provisions may not be available in all states. Approval may be subject to the terms and conditions of the insurance company. Insurance product guarantees are subject to the claims-paying ability of the issuing insurance company and are subject to their terms and conditions. Christopher Panayotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Capitalize Your Finances or LPL Financial. LPL Financial California Insurance License number 0518721. LPLIA California Insurance License number OB91442.